Good morning. It's 7:16, so we'll get going as always. Feel free to ask questions at any time, and hopefully we get some interaction, but otherwise we'll see what happens. So let's get going here. The highlight of the week, if anyone cares, K-State is playing in week 0. And Mike Hellman agrees. No one cares, but I think we have a lot of K-State fans who, are rooting for their Wildcats this weekend. So we'll see what happens at 11 a.m. on Saturday. As we said before, this could lead to, higher or lower wheat acres, depending on how good the Cats are this year. So any questions there, we'll repeat that slide from last week. So we'll go into the WASD summary. This had some pretty big impacts on flat price last week. The big one, corn, we had an increase in acreage, an increase in yield of almost 8 bushels to the acre, bringing out a massive corn crop. I think everyone knows it's going to be a good corn crop and probably a record yield, but 188.8 is, almost 9 bushels to the acre record. So, an extremely big corn crop. Even when we start moving locally, they have Kansas and Oklahoma yields very strong as well. So, the biggest thing for us here locally is when we'll actually get into corn harvest. A lot of the guys thought we'd be into corn harvest almost a week and a half ago, and we're still not seeing corn. So, if any of you guys, think you'll be in the corn pretty soon, that would be great for all of us. Going into beans, they had the opposite acreage. They're lower and tightening up that carry out considerably. We'll need to watch that export demand side, which we'll touch on later. But the carry out's down to a tighter level than previously thought. Hard wheat, we did see the export sales finally roll into an increase in exports. They raised them 25 million, probably still light, but we'll touch on that here later on. Corn yield's going to be the biggest one nearby here. We have increases year on year for almost all the core states. For Kansas and Oklahoma, we're up 10 bushels to the acre and 32 bushels to the acre respectively. And, we'll have to see once we start getting into this corn crop, but it's going to lead to, a big feed grains crop here in the West. Crop conditions came out last night. Once again, crop conditions are extremely good in comparison, especially for corn. Beans actually increased week on week. So, the crop conditions justify this larger crop. And, locally, our conditions did drop in Oklahoma. We've had this dry stretch, but, with us getting into harvest, it's not too much of a concern here short term. Couple of the states to watch, if you start looking into Illinois, Indiana, Ohio, USDA has very high yields for those states. In comparison to their crop conditions. We did get Pro Farmer's estimate on Ohio yesterday, and it came in at 186 versus USDA at 196. So, we could see some questions on some of these yields state by state, and are just going to have to watch it here as we get closer to harvest. Pro Farmers, the big crop tour going on right now. Historically, they, will underestimate the crop. So for USDA's justification at 188 on corn yield, we need to see a Pro Farmer yield somewhere around 185. So the first 2 states are done, with South Dakota being higher than USDA, and as I just said, Ohio came in about 10 bushels lower than USDA. So as we move throughout this week, the market will be watching, where Iowa, Illinois, and Indiana come in. And then, we'll have to adjust then based on their yield if 188 is an actual achievable corn yield for the state or for the nation. Weather short term, there is more moisture. The longer term forecast continues near normal rainfall across our areas, and we do get a cool down here. So, pretty good conditions for a majority of the corn and bean crops. And then we'll just have to see if it affects our corn harvest here in Kansas and Oklahoma. So after the crop report, we saw the big swing, wheat and corn down, and soybeans had a very strong rally with lower acreage. So, it's very reflective of what the USDA report gave us, led the direction on flat price. CFTC positions, we did see some covering in hard wheat. That was through Tuesday. So, the net to net after Wednesday through Friday will probably be down again in hard wheat for the managed money positions. We did see the big covering in the bean position and probably expect more covering there on the bean side. Otherwise, the funds are going to hang on to these overall short positions in corn and wheat. And looking at wheat by itself, the interesting part is Matif, their spread curve inverted, sep to Dece, which also kind of aligns with some of the short covering we've seen in Matif. As you start narrowing that spread curve, the funds are less likely to hold long-term short positions. And when you look at the KC spread curve, the sep to July 26, we still have a very good carry structure in place. So the funds aren't going to want to lift that short position unless there's a strong fundamental reason, especially when the market's basically paying them to stay short and continue to drive front end prices down to recent lows. So let's go into commodities now. World corn, we have plenty of corn in the world. There are no big issues there. I think the one thing that's hanging over the demand side of the market is China continues to export beans out of South America. So the big South American, especially Brazilian crop that's nearly 140 million tons has not come to the market yet, allowing a longer export period here than the U.S. probably expected. Historically, when we see big South American crops, it takes straight away from U.S. exports. If you look the bottom right in 2022, we had a big South American crop and U.S. exports got hit every time we've had larger South American export programs. So the question is going to be is USDA is plugging in a full-scale export program, and when will South America come in to compete for the U.S. Corn export business? So when we go over to the balance sheet side, last year we did nearly 2.8 in exports, and USDA is already projecting a higher export number with that. So that'll be the big question on the export demand side. But they also have increased domestic use from last year. So, when you're looking at the balance sheet as a whole, they have very high use plugged in to kind of offset the record crop that they have in place here. So, the balance sheet from USDA is a 2.1 carryout, but some of the market has 2.3 to 2.5 in carryout if we can really justify the yields that are out there. So what does that, mean? We got to stay extremely competitive with corn to continue this export sales pace. And as we see, this is be one of the bigger export years if we're able to hit that export number that USDA has in place already. On Milo, I think the biggest thing here is USDA on their export number is plugging in a sizable Chinese program. So last year, we did 100 million bushels of exports, which included 40 million to China, which was early in the marketing year. That was last September, October, November. We don't have that in our balance sheet right now. There are no sales to China. So we're going to be relying on Spain, Mexico, or other places that are using this as a replacement to corn. And realistically, to get to 115 or 100 million bushels in exports without China is very unlikely. So, we could be looking at a carry out 150 million bushels plus if we don't find, a Chinese market or additional outlets. We can only pound so much domestically, which, we'll have to watch and see. But there is a chance that we have extremely high carry out for Milo this year. So locally here, if we start to go through just Kansas, Oklahoma, Texas, we did get an increase in acreage week on week, or I guess from the recent report here, up 550,000 acres of corn in Kansas. And then we did see an increase in Milo acres for both Kansas and Texas. So if we start to plug this in, you can increase our production considerably here, which is already going to be, taxed in terms of space. So the question will be is which commodities are going to pay the best carry. And without a Milo program right now, Milo is probably going to have to work towards space. And then we'll have to see if corn or wheat pays the better carry here, or if which commodities will end up going to ground long term. Corn basis, just for people to see here, corn basis has slid. This is Colwich, Kansas. Everyone's seen it. Corn basis is off considerably. So is Milo basis. 2 months ago we were 15 over in Colwich. Today we're 25 under. Anywhere you go, finding a bid for nearby corn is pretty tough. And even going out farther in the deferreds, I don't think anyone wants to step up and really own corn at a big premium. So, is it a longer term at these lower levels, or will we see a pop as we go forward? Just with our stocks and production, it's probably a cheaper premium market than it was last year. Milo basis, Salina on the left, and then Houston, Texas on the right. You can see last year we had Chinese demand at the beginning of the Houston market where it was trading 150 over, and now the market's paying 30 over. So that's being reflected back into the interior, which you can see at Salina. We've drifted from, 500 to 65 under. So, the market's reflecting what's going on in terms of exports. And if you have to be a replacement to corn in the ration to go to Spain or Mexico, there is a chance here that Milo premiums continue to get cheaper, especially if the only option is going to the ground long term. So corn price outlook, a lot of this is going to depend on what we see out of these crop tours. It's a big corn crop, but I think we'll get some bounces here to trade somewhere versus the D's between 410 and 425. But, as long as the crop is 185 plus, you're going to struggle to have any extended rallies. And even if we look back into last year, we were able to get 475 to $5. But we also cut 500 million out of the balance sheet in December and January last year. So unless we can do something like that, trading above 425 or 450 long term doesn't look like it would be extremely likely. Soybeans, like we said earlier, the balance sheet got cut below 300 million. We'll need to watch the yield for sure. USDA is plugging in a 53.6. And if we start to see that drift down closer to 50, you get an extremely tight balance sheet with stocks to use, below 5%. So I'm fairly optimistic in beans here. And, we'll need to watch as we go forward if we can get a Chinese program built into this market. As we sit right now, we're not seeing any of that Chinese demand. It's all going to South America. And, the South American production is huge. The question will be is, will they need to export corn and take a break from exporting beans and give us a chance, or will Trump get something done where the Chinese do come in and need to buy beans? If that's the case, you could tighten up this balance sheet pretty quickly. So in terms of price, short term here, 1050 to 1075. If we get China into the market, we could trade $11 beans again pretty easy. World wheat, nothing's really changed. There's plenty of wheat in the world. Stocks to use is extremely comfortable, which is reflected in some of these world prices. The one surprising thing is the U.S. market has been competitive, especially hard wheat, and that's more of a quality issue. There are some quality issues around the world, and we'll need to see if the U.S., with us continuing to trade near $5 and putting on, more and more sales here, if the U.S. needs to price out of this demand, or if we're going to continue to have a very strong export book. Our sales progress is great. We're above average going into Nigeria, going into Venezuela. I mean, those two markets had been on Russian or Baltic wheat, and now they're back into the U.S. and, looking for more U.S. wheat as they digest the quality from other origins. But as we sit today, I mean, USDA went to 300, and in my balance sheet, I've got 325 right now. I think that can go higher if we stay competitive here longer. And that ends up, we still have a comfortable carry out, but, you add another 25 or 50 million to the export number and you get back to a tighter carry out than we have seen, prior to 2022. So for the price outlook versus the SEP, I don't think we have a lot of room to run here versus the SEP, maybe 15 or 20 cents, just with us running out of days to trade against it. But I think if we continue to stay competitive, we'll get a chance to get a market rally and trade 540 to 565 versus the Ds. One of the big things still is 26, 27. The spread curve is giving us good opportunities, above $6. If we get a rally here in the front end. So, if you talk to your RMAs or want to put in some open orders to sell $6 wheat, that'd be an opportunity. They might not be long-lived rallies, but at least if we do get a short covering for hard wheat, you could get some opportunities out there in some of these deferred months. And that's what I've got for today. Are there questions from anyone?
I think all of us have read a lot of articles over the last couple of weeks in terms of just how do we curb some of this price depreciation, especially in fall crops, corn and Milo. Government mandates going from E10 to E15. Trump with the ultimate plan of hopefully increasing corn exports and Milo exports. In your opinion, even if we strike some of these deals, how long does it take the market to feel this price action, and especially from like a sustainability standpoint, how do we sustain that price if it does rally?
I mean, the biggest overhanging thing here is carry out for corn. So, I mean, if you're a 2.1 to 2.5 carry out in corn, you're going to struggle to have any long-term sustained rallies, at least here over the next 6 to 8 months. They're talking about higher ethanol blends, and if you increased up to a full 15%, that you can increase, 500 million to a billion bushels of corn into ethanol. But, how long does that take before that comes into action and we see that ethanol grind? I don't know on that side, but yeah, we're going to have to find some way to dent the balance sheet. And, with already extremely high use numbers plugged in, we're looking at a hard hard road, at least for the next 6 months, until we get to probably anticipated acres and see where we are for next year.
You know, even in some years of like larger crops, we see imported commodities coming into the United States. Do you anticipate any of that happening this year?
No, I mean, not on corn and wheat. So, I mean, the price spreads, if US is the most competitive for exports, I don't see us. You know, the price spread on wheat was $100 a ton for, you know, some of that EU wheat to work into the US. So, I mean, it's got to be a major swing here in prices. And right now, you know, a 50-cent rally or a dollar rally in hard wheat still doesn't bring any other origin into the US.
So where we're priced right now with hard wheat, what takes us out of the markets? We're in the market today. What takes us out of the market? A price rally? Is that the only thing, or
A price rally on hard wheat only, or other origins dropping their flat price. So if Russia starts to get into better quality and all of a sudden needs to compete because they are behind pace right now, you know, do they come in and go from 240 down to $210 a ton and try to regain some of this business? You know, that could be what would take us out of it. But based on the sales we have on the books and then routine demand, 325 is a pretty safe number anyway. So I think we'll stay competitive. You know, I think we could rally, if the world stays the same, we could rally 50 cents and keep our routine business.
on Milo exports, everybody keeps talking about Trump and China and everything else. If we do get say we get Milo exports on next month, when does that value filter back to the country up here? How long does it take before we see
I mean, if we start to see sales, it'll be a premium rally. You know, flat price is going to be dependent on corn, but if we see them come in for Milo only, I think it'll bump the premium side pretty quick. People will get bullish. You know, you'll see a first round of sales get done, then expectations are 20 cents higher. And that's, you know, in previous years of Chinese demand, you've seen it basically go from, you trade one number, you move up a quarter, you trade, move up a quarter. So if there is a big program, yeah, we can expect a pretty good premium rally, especially from the low starting point. Question is when?
with all the extra carry out we had from a year ago that we've carried in and the large crop it looks like we're having, how big of a program do you think we need? Like one of the top 15% with them to really actually get to see those big numbers that we used to see?
Yeah, I mean, you're gonna have to do 175 million bushels of Chinese demand, at least.
And that would go back, we haven't done that since like 21 or something like that.
I would have to go look, but yeah, it would take one of the bigger export programs and, you know, you would probably have to do 200 million because if China comes in, you're not going to do Mexico and you're not going to do Spain. So, you know, the Chinese program is going to have to be pretty big. And even if you do 200 million in exports, you're still 50 to 75 million bushel carryout. I mean, you're not 20 million like you used to be in carryout. So those years that you traded 200 over or something like that, Texas Gulf probably aren't likely unless you're able to have a massive Chinese program.